Okay, let's unpack this. If you really want to be well-informed about a company's finances, you have to look past the numbers themselves. You have to understand the philosophy behind the balance sheet.
Exactly.
So for this deep dive, we are not here to crunch numbers. We're getting into the foundational conventions, the invisible rules of the road that determine the quality and the meaning of what's presented to you.
That's a great way to put it. The metagame.
The metagame, yes.
Yeah.
We've got 5 key conventions to cover, and our mission is to pull out the surprising trade-offs and the human judgments in all of this. Because if you understand the rules, you start to understand the bias.
You're absolutely right. These conventions, they really reflect this fundamental tension in all of financial reporting.
Attention.
Yeah. It's this constant battle between wanting to know something fast and wanting to know it precisely. And, well, you rarely get both.
Which takes us right to the heart of it, doesn't it? The biggest conflict. The trade-off between relevance and reliability.
It's the core choice, really. So when we define relevance, we're talking about the capacity of information to actually change a user's decision.
So it has to matter.
It has to matter. To be relevant, the data has to be timely. You need it now. And it has to be useful for looking at the past or, more importantly, forecasting the future. It really favors that instant forward-looking data.
Okay, so if I'm an investor, I want to know what this company's going to do next quarter. I want the most relevant information possible, even if it's, an educated guess.
Precisely. But the moment you start guessing about the future, you start to sacrifice reliability.
Oh.
Reliability means that users can depend on the information. It has to be accurate, representative, and this is the crucial part, verifiable.
Verifiable meaning anyone can look at it and come to the same conclusion.
Exactly. If 3 different people look at the same data using the same procedures, they should all get a similar result. It naturally loves historical, double-checked facts.
I can see the clash right there. If I wait 3 months to verify every single penny, that data is super reliable. But it's old news. It's lost its relevance.
And on the flip side,
If I rush out a forecast based on a gut feeling, it's highly relevant right now, but the uncertainty means it's not very reliable. Sounds like you have to pick a side.
that is the trade-off. Think of it like this. Relevance is a modern weather forecast. It's fast, it's useful for today, but, it could be wrong. Reliability is more like a detailed geological study from 6 months ago. It's slow, absolutely verifiable, but maybe useless for planning your picnic this afternoon.
That makes the stakes really clear. So what's a real-world accounting example of this tension?
The sources often point to environmental cleanup costs.
Okay.
So if a company has to clean up an old factory site, estimating that future cost is hugely relevant to anyone buying the stock today, you need to know that risk exists.
But you can't know the exact cost.
No, it's incredibly difficult to quantify. You're making assumptions about technology 10 years from now, inflation, future laws, so it's not very reliable.
I can see the dilemma. I would guess that historically, accountants probably leaned really heavily toward reliability. Precision above everything else.
Yeah, absolutely, they did. But the modern trend is shifting. In this fast-paced world, investors are demanding relevance. They'll accept a degree of estimation if it means they get faster insights.
So the focus is moving more towards, is this useful now, rather than, is this perfectly verified later?
That's the philosophical shift in a nutshell.
Okay, so moving from that internal conflict of speed versus accuracy, what about comparison? How do we make sure we can compare Company A's report against Company B's, or even against its own report from last year?
That brings us to comparability and consistency. They are absolutely essential. Without them, finance would just be storytelling.
Just a collection of numbers without context.
Exactly. So comparability is the ability to compare financial information across different companies. This is why we have a common playbook of rules.
That would be GAAP, right? Generally accepted accounting principles.
Right. In the U.S., it's GAAP. If Company A and Company B both follow GAAP, it lets you spot the similarities and differences, which is vital for any investor.
So it's the common language everyone agrees to speak.
Precisely. And while comparability is sort of horizontal company to company, consistency is vertical, it's about a single company over time.
So using the same methods period after period.
Yes. Consistency means a company uses the same accounting methods for the same things from one year to the next.
Why is that so important?
Because it lets you track performance trends. If a company changed how it valued its inventory every single year, you couldn't tell if profits went up because of good sales or because they just picked a new accounting trick.
Ah, I see. So consistency, make sure you're looking at a real operating trend.
And that's why consistency is seen as a subset of comparability. You have to be able to compare a company to itself over time.
And if they do change a method,
They have to disclose it. If a company decides a different method is better, the change has to be clearly explained. That way you, the user, can adjust your analysis and still see the trend line. You have to know when and why they change the rules on themselves.
that feels like the only honest way to do it.
Yeah.
Okay, let's pivot to what I think is maybe the most controversial of these principles, conservatism. It sounds like it intentionally introduces a bias.
It does. The core principle of conservatism is simple. It's something your grandma might say. When in doubt, recognize all your losses immediately, but don't recognize any gains until they are certain.
So expect the worst, but only count the best when the cash is in your hand.
That's it. And it has a really powerful historical reason. It was mainly favored by lenders, by banks, who for a long time were the dominant users of financial statements.
And lenders only care about getting their money back.
Exactly. They don't get the upside. So by encouraging managers to always understate assets and overstate liabilities, this convention gave them a bigger margin of safety for their loans.
That makes perfect sense if you're a debt holder. But wait a second. If the goal of modern reporting is to be unbiased and neutral, why would we tolerate a rule designed to introduce a downside bias? Isn't that just lying?
That is the modern critique, and it's a good one. Mindless, pure conservatism does create biased reports. It makes a company look intentionally worse than it is.
So what's the status of it now?
Well, that's why accounting standards bodies, like the FASB here in the States, have moved away from it as a formal, standalone principle. They really favor neutrality.
But it's still used in practice.
It is, and what's fascinating here is that even as the formal rules shift, the human element keeps it relevant. Managers, entrepreneurs, they're naturally optimistic people.
Right, they always think their new project is going to be a huge success.
And conservatism acts as a useful counterbalance to that inherent managerial optimism. It's a check on the hype.
So it's not an official rule, but it's like a gravitational pull that keeps aggressive managers from flying too close to the sun.
Precisely. It's a necessary dose of skepticism baked into the process. It helps ensure the statements show a realistic picture, not an aspirational one.
A dose of skepticism, I like that. Okay, let's move from that philosophy to the ultimate practical test, the does it even matter rule, materiality.
Right. Materiality is all about professional judgment. It might be the most important concept an auditor uses, really. An item is defined as material if accounting for it incorrectly could influence the decision of someone reading the report.
And if it's too small to change their decision,
Then it's immaterial.
this is where common sense comes in, right?
Yeah.
Like, if a huge global company buys a $10 trash can, they could technically capitalize it as an asset and depreciate it over years.
But that would be ridiculous. It's immaterial, so you handle it the simple way. You just expense that $10 trash can immediately.
But if an item is material, if it's big enough to change my mind, it has to be accounted for perfectly according to the rules.
Exactly. And this is key for auditors. They can't check every single transaction in a multi-billion-dollar company.
So it dictates the scope of their work.
The entire audit. They focus their energy on finding errors that are big enough to be material to the overall financial picture. They're not worried about a $5 discrepancy on an office supply receipt.
Okay, but doesn't that open a door for abuse? Say a manager commits a $10,000 fraud. To a billion-dollar company, that's immaterial. If they do that every month,
That's a critical challenge.
couldn't those systematic, smaller frauds get missed?
They could, and that's why professional judgment has to go beyond just the size. Auditors have to consider quantitative factors, the dollar amount, but also qualitative factors.
Like what?
Like, does the error hide a contract violation? Is it related to a key performance metric that managers get bonuses for? And crucially, is it hiding a pattern of intentional fraud? If a small error is the thing that turns a net loss into a net income, even a small dollar amount becomes material. It fundamentally changes the story.
So it's not just a math equation. It's a contextual, common-sense assessment of risk and intent. The key insight is that a $1 million error is huge for a small business, but for a giant tech company,
It's utterly irrelevant. Exactly. People use rules of thumb like 5% of net income, but those are just guides. They never replace professional judgment.
we spent all this time on the rules for individual numbers. Let's zoom out now to the final piece, how the entire structure holds together. The big three statements: income statement, balance sheet, cash flow. How do we know they actually talk to each other?
That's the beautiful concept of articulation. It means the three primary financial statements aren't just isolated reports. They are an integrated set. They have to fit together perfectly.
And if they don't articulate?
The whole financial story falls apart. It means something is wrong.
This is where it gets really interesting for me. So what's the anchor that holds it all together?
The balance sheet is the anchor. It gives you the company's position assets, liabilities, and equity at one specific point in time. It's like a photograph taken on December 31st. The other two statements are the story. They explain how the company got from the opening balance sheet to the closing balance sheet.
So the balance sheet is the map, and the others explain the journey between point A and point B. What are those specific links?
There are two main connections. First, the income statement, which is your revenues minus your expenses.
Your profit.
Right. That profit, combined with any dividends paid out to owners, explains the total change in the retained earnings account on the balance sheet.
So that's the equity link. It makes sure the profit is accounted for.
Yes. And the second crucial link is cash. The statement of cash flows explains in detail the change in the most important asset, the cash account on the balance sheet.
Where it all came from and where it all went.
Every dollar, broken down by operating, investing, and financing activities. And what's more, the income statement and the cash flow statement are linked through all those accrual adjustments. This whole integrated web of numbers is what proves the integrity of the system. If the ending cash on your balance sheet doesn't match the ending cash on your cash flow statement, the report is broken.
This has been an incredibly useful deep dive. We started with that foundational choice, didn't we? Between relevance, speed and estimation, and reliability, which is precision and verification.
And we saw how that trade-off really drives so much of modern finance. Then we look at comparability across companies and consistency over time.
The guardrails that make the reports useful, the common language we call GAAP.
Exactly.
We then got into conservatism. Even though it's not a formal rule anymore, it still acts as that practical counterbalance to all the natural managerial hype.
And then materiality, the subjective doesn't matter, test that dictates how precise an accountant really needs to be.
And wrapping it all up with articulation, the idea that these aren't just separate documents, but a single unified story.
And I think understanding these five conventions, relevance, reliability, comparability, consistency, conservatism, materiality, and articulation, it gives you a critical lens. You can judge the quality and meaning of any report. You're no longer just reading numbers on a page. You're understanding the judgments, the trade-offs that were made behind the scenes.
It transformed you from just a casual reader into a critical analyst.
And if we connect this to the bigger picture, that tension between relevance and reliability means every big financial decision really starts with a choice. Do you prioritize speed and estimation, or do you prioritize precision and certainty? So that raises a question for you to think about. When you're making your own high-stakes decisions, whether it's an investment or running a business, which side of that trade-off do you naturally favor, and what risk are you accepting by doing so?